Hey everybody, good morning. We are going to get started in 2 minutes. Thanks for joining us today and taking time out of your busy day. We appreciate you being here. I'm going to mute myself and take a sip of coffee. Hey everyone, thanks for joining today. Just a heads up, we're going to get started in about 1 minute. We appreciate you taking time out of your busy day to be here with us and with me. Hey everybody, thanks for joining. I know you guys are rolling in. We're happy to see you. Well, we can't see you, but we're happy you're here. We're going to get started in a couple minutes. Again, thanks so much for being here with us today. Hey everybody. Again, just checking in quick. We're going to get started in a minute. Thank you all for being here today. All right. I just got the cue that everybody is on, which is fantastic. So just a heads up, I can't see you and I can't hear you. I just want to remind you that if you have any questions about the presentation or how anything that we're covering today relates to your own financial plan, please make sure to reach out to your SPG advisor after the presentation. So, hello, good morning, good afternoon from maybe you're joining us in a different state, but we're really happy that you're here and thank you for being here. I am Alison Wyshock. I am one of the financial advisors at Secure Planning Group. So every time or every year around this time, I should say, we like to take a step back from the daily rush, the daily chaos of our lives and of the news cycle and take a look at that bigger picture of things. So we're going to be going through and kind of walking through step by step and page by page, if you will, the second half of 2026 using LPL's Research Midyear Outlook, and that's entitled Policy, Buildouts, and Bottlenecks. The goal of today is really simple. So we're going to be skipping all the heavy financial jargon and we're going to get some pretty concrete answers to the exact questions that are on your mind. And I know that because I've been, meeting with a lot of clients over the past 6 months and I know the things that are going through your head. So there's four main questions that we're going to answer today. The first one is our economy actually on solid footing? Second one is, can the stock market keep climbing? The third is, what's actually going on with interest rates? And the fourth is, how do we handle political climates without reacting emotionally? And I know there's a lot of emotion that comes with finances. So we're going to be tackling those four questions, making sure that we get answers to those today. So the short answer is that, well, the first half of the year has been very busy and has tested us a little bit. The economy really proved to be pretty resilient. So looking ahead, we are really optimistically cautious. And that path forward might be a little bit complicated, might be a little bumpy, we might have some volatility, but that underlying foundation is really, really firm. So let's start with Washington. And I know a lot is going on in this slide, but because the upcoming midterm elections are going to really dominate the headlines, as you can see on this slide and on this map, every single House seat is up for election, along with the key portion of the Senate. Right now, the data suggests our baseline expectation should be a divided Congress. We could see Democrats take the House by a very narrow margin while Republicans retain control of the Senate. Now, of course, as we all know, forecasts are an educated guess. But as an investor, the political party matters less than the political balance. A divided government usually means a gridlock. Fewer major sweeping laws tend to get passed. Businesses like predictability. When they know the rules of the game, aren't going to change dramatically and radically overnight. They tend to feel more confident about investing and about hiring. However, the gridlock actually does mean that we will see plenty of noisy headlines. We all know you guys are, looking at articles on your phone, watching the news, so you're going to see a lot of headlines around government funding, debt ceilings, and taxes. The political theater always, as you guys already know, creates that short-term volatility in the stock market that we tend to see. Certain sectors like banking, healthcare, and digital assets will be extra sensitive to that. But as your advisor, I'm sure, has talked to you about this before, this is exactly why we have that deliberate, separate, long-term investment plan. And we have that, This is why we have that deliberate, separate, long-term investment plan, and that's going to be separate from the short-term political prediction. We don't want to rely on political predictions. We want to focus on your long-term investment strategy. If you look back through history, American companies have successfully grown under every sort of imaginable combination of political leadership. We do not change a strategy based on an election forecast. We want to stay anchored to your goals and your overall financial plan. So the next theme is something that economists call resource nationalism. And you're probably like, what does that even mean, right? So that just means that governments around the world are changing the way that they view raw materials. Instead of trading items like oil, lithium, copper, and computer chips freely, countries are treating them like critical national treasures. So let's take a look at this chart. It shows how sharply countries have restricted their exports since 2020. And why is that? Because recent history has made countries really realize that if you rely on your overseas neighbor for critical supplies, that can make you really vulnerable. So now countries are waking up saying, we are keeping our raw materials first. When governments restrict access, supply chains tighten and prices fluctuate. This matters because these exact materials are the building blocks for data centers, computer chips, and manufacturing. For your personal portfolio and your long-term financial plan, this really does not mean that we're going to go out and gamble on commodities. Instead, it means that we're going to recognize that industries like energy, materials, and infrastructure are playing a much more valid and defensive role in a diversified portfolio than they were a decade ago. This is a big one. AI, right? Everybody's talking about artificial intelligence, and this is a huge theme of the outlook that we're going to be talking about. So what does this chart actually show us other than beautiful colors here? It shows us the staggering amount of money that is going into AI, which I know is not a surprise to anybody that's joined this meeting today. The world's largest tech giants like Microsoft, Google, and Amazon are investing hundreds of billions of dollars into data centers, massive computing power, and of course the electricity that's needed to run it. In fact, it's estimated that the top 5 tech companies are going to spend over $750 billion this year, and it could cross $1 trillion next year. Crazy. That massive amount of spending just ripples out and boosts into the broader economy. It creates heavy demand for local utilities, industrial manufacturing, construction companies, and raw materials. I was actually just talking with a family member the other day. He's a retired electrician, and I'm like, you should get back into it, do something part-time, because I know there's a huge demand for electricians right now because of these data centers that are coming about. Notice how the conversation that we've been talking about is shifting in the second half of the year. And it's shifting, the phase 1, I should say, is purely about speed. It was all about who can build these data centers the fastest. And in phase 2, which we are now, is really about accountability. It's who is actually turning this massive spending into real revenue and real corporate profits. So this AI story, of course, is incredibly powerful, but Wall Street is really becoming more selective and sensitive to it. Investors are starting to reward the companies that turn AI into efficiency and earnings, and that's really where we're focusing our attention. The fourth topic that we want to pay attention to is the theme, or I should say the fourth theme is the Federal Reserve, right? Interest rates. So we had a historic milestone this past May when Kevin Warsh took over as the new chair of the Federal Reserve. And Kevin brings slightly a different philosophy to the job. He prefers a lighter touch, meaning he wants to let the free markets do more of the heavy lifting when it comes to setting prices. So the chart that you're seeing on the screen is a great reminder that when bond yields go up, it doesn't automatically mean it's a bad thing. Often yields rise simply because investors feel good about the economic growth. Now, if you're looking to borrow money or get a mortgage, as I've been talking to clients over the past 6 months, past year, these higher interest rates for sure are more painful. But for savers and more conservative income investors, the higher yields represent the best opportunity that we've seen in nearly 2 decades. You can finally get some pretty good, reliable returns on safe fixed income investments. Because inflation is still hovering above the Fed's comfort zone, we do expect the Fed to mostly sit on its hands for the rest of the year. We might see one interest rate cut the end of the year, but that's still really going to depend on energy and oil prices. So let's shift our focus directly to the economy. If you remember one phrase from today, I hope that you remember this. The economy is experiencing slower growth, but not a stop. We do not see a recession on the immediate horizon. Instead, the economy is settling into a more normal, moderate pace. So think about it like driving a car. Slowing down from 90 miles per hour to 65 isn't a crash. It's just sensible driving. So if you take a look at this slide, you can see the different moving pieces of our economic growth. Don't worry about all of the fun colors on the chart. Just know that the key takeaway is that massive corporate spending on technology and infrastructure is successfully offsetting weaker spots like housing and keeping our overall growth moving in the right direction. And if you're like most people and most of the clients that we're talking to and day-to-day friends and family, inflation is probably one of your top concerns. It's also one of the biggest risks to our economic outlook. So recently inflation ticked up to about 4.2, and that was mostly driven from rising energy costs linked to conflicts in the Middle East. If the energy markets can't calm down, the expectation is that inflation will drift, or excuse me, I should take that back. If the energy markets can calm down, totally goofed on that. The expectation is that inflation will drift down to 2.9% by the end of the year. So that's a pretty significant decrease. But notice, of course, the words if and toward. Progress, of course, is never a straight line. It's usually always a jagged staircase. Another spike in oil prices could easily keep inflation and therefore interest rates a little bit higher for a little bit longer. Now let's switch into the stock market. We do believe that this positive market cycle has more room to run, supported by solid corporate earnings, AI investments, and a growing economy. However, after a really strong start to the year, we should expect some normal stock market turbulence in the months ahead. One of the healthiest signs that we're seeing right now is actually shown on this slide. Typically, Wall Street analysts start the year with really sky-high expectations for company profits and then slowly lower them as reality sets in for the year. But this year has been the exact opposite. Analysts have been steadily raising their profit estimates for both this year and next year. So while strong corporate profits can't completely prevent a short-term market pullback when a scary headline hits, they do provide a very solid fundamental floor beneath that stock market. More on the tech sector, right? Because we're just hearing so much about it. And one of the key points on this slide is that AI enthusiasm drove a massive 225% surge in chip stocks versus, in comparison, 35% for the S&P 500 over a 14-month period. It's crazy. Because investor positioning has really become overcrowded, the tech sector was downgraded from overweight to neutral in early June. And not because earnings were bad, they did grow 50%, but because AI trade needs a little bit of a breather. LPL's research base case assumes that AI earnings and positive macro drivers are going to push stocks higher, but do expect a bumpy ride due to geopolitics and high market expectations. So LPL Research S&P year-end forecast, as you can see on the screen, is 7,650 to 7,750. And I wanted to give you just a little bit of context. As of today, July 21st, right before I jumped on this webinar, 11 a.m., it was 7,487. So there is definitely room for that to keep going up. Just as I said, LPL Research's base case assumes those targets for the S&P. Now let's shift to bonds. The chart on your screen shows how quickly expectations can shift. At the very beginning of the year, Wall Street was convinced that the Fed was going to cut rates multiple times. By June, the market was so worried about inflation that people were whispering about rate hikes. We don't expect the Fed to start hiking rates again, but you can see these wild swings show why we don't build an entire investment strategy around a single interest rate prediction. As I'm sure you know, and talking to your advisor, that trying to predict and time the market is a losing game. For income investors, bond yields are the most attractive they've been in years. Right now, we're seeing excellent opportunities in short-term government bonds and high-yield corporate bonds to help secure reliable, safe income for your portfolio. And our final market update brings us to the real-world constraints that affect our everyday lives: energy, metals, and gas prices. Oil is a textbook example of how tight supplies impact both global markets and your household budget. As you can see from the forecast on this slide, global oil supplies are expected to remain tight well into 2027. I know that's probably something you didn't want to hear. While there isn't a lot of extra oil to go around, any global disruption can cause a sudden jump at the gas pump. This again reinforces why we keep a meaningful presence in energy within your portfolio, as it acts as a natural shield when everyday living expenses are rising. To put a bow on everything that I've covered, our core message, I want to hit home that our core message is one of constructive optimism balanced with healthy caution. The big picture is highly encouraging. Our economy is growing, corporate earnings are strong, bonds are paying really meaningful income, and the massive build out in technology is really opening new doors. At the same time, we have to respect the real uncertainties of the next 6 months. A noisy election cycle, global tensions, energy prices, and a brand new leader at the Federal Reserve. As an everyday investor, your job is not to guess what the next headline is going to be. The secret to a financial peace of mind is maintaining balance. And I know that's hard. I know it's hard not to read the headlines. How do we accomplish that balance? We do that by sticking to your personalized long-term plan, ensuring that your portfolio is properly divided and diversified across different industries, getting those great income yields that are available right now, and regularly checking in with us or checking in with your advisor to ensure that your portfolio and that your plan is still aligned with your personal goals, objectives, and comfort risk. So I really want to thank you for coming out today, tuning into the presentation. I know that your time is precious. We really appreciate it. Hope that you found this valuable. And if you have any questions on anything that was discussed in the presentation, please make sure to reach out to your advisor at Secure Planning Group. We're always happy to help, and we hope that you have a great rest of your summer and a great rest of 2026.